Excellent. Well, welcome everyone to this evening's webinar on preparing a roadmap for a potential profitable practice sale. Right. I'm joined today with Mr. Stuart Orbach from Henry Schein Dental Practice Transitions Team. He's a transition specialist, as well as Mr. Chad Clark, who's the Senior Vice President and Regional Sales Manager with Bank of America Practice Solutions Dental Financing. So we're very excited to have everyone in attendance this evening. I'm just going to open everything up with a poll just to get a good gauge of the room. It helps the three of us get a good understanding of who we're speaking to this evening. So I'm just going to pull that up here in a second, let the remainders of the individuals trickle through, and then we'll get this evening's webinar started. So I'm just going to pull that up there for a brief moment for everyone. As I said, while some additional members I see here are trickling through, please feel free to take a look at the polls, insert your answers there. Like I said, that just gives us a good understanding of who we have in this evening's webinar and how we can best cater the information. Additionally, as we go through this evening, there will be a question and answer section, as well as a live chat. I encourage everybody that throughout the presentation to ask questions on the material as it's fresh. We will be answering questions at the end of the webinar. All right, and with that, I will cut out some time. If you want to hold your questions to the end, you're more than welcome to do so. But if you feel like asking during the presentation, also feel free, no troubles at all. Excellent. I'm just seeing quite a number of answers coming through here, so I'll just let everybody take a look, go through. Excellent. Perfect. Wonderful. So, like I said, once again, thank you everybody for attending. Really, I'm just going to run through the purpose of tonight's webinar, and then I'm going to pass it on over to Chad. But really what we're going to do today is we're going to go through what is the mindset of today's buyer? What is the impact that the DSOs have had on the market? What are some of the changes to the valuations in 2023? And then we're also going to go through some case studies, some of the pitfalls that you'll typically see, and what are some of the items that you need to fix in order to prepare for that practice sale, right? We're also going to look at what are the availability requirements in lending, what are some of the traps that could hinder the sale of your practice or the value of your practice as you move forward and set up for that transition, and the importance of the term on your lease and how that can have such a large effect on the ability to sell and what that all looks like. But without further ado, Chad, I'll pass it over to you.
All right. Thank you, Matt. Good evening, everyone. And thank you for joining. So kind of the role I have at Bank of America is I manage the state of Florida, specifically for practice acquisition. And I've been at the bank 16 years, and I know there's a lot of folks that are, I'm based out of Florida, but there's a lot of folks that are across the country, maybe just even in Canada. So I do have teammates across the country as well. So, but I just wanted to give everyone a little bit of a state of the market, right? So still very much a seller's market. So, depending on your, the state that you're in, there will be some variability in that. But overall, definitely consider it a seller's market. Rates, you've probably seen, for sure, have increased significantly over the last year and a half. That has not slowed down the buyers. So that's not been a barrier. Banks are very aggressive in lending to dentists or doctors. The default rate is basically zero. It's very, very low. So banks tend to get very creative and aggressive in their terms. So 100% financing, no down payment, lending up to 95, 100% in some cases of collections, and even lending 100% up to on real estate. So the profile that you're going to see, I mean, there's a couple different profiles, but as far as associate doctor, it's typically going to be your doctor that's 1 to 5 years out of school. And your buyers are going to be, they know the market is a seller's market. They know it's tough out there. And, they've probably had some scars and learning when they see a good practice that they have to pull the trigger quickly on it, right? So they seem to be very, very educated in the process. There's been a sharp uptick as well in, I would say, in the last 3 to 4 years of multi-practice owners acquiring further, the 5 to 20 practice owners, and that's just become more, with the corporate DSO, that's become more prevalent, in the last couple of years. So if you want to go to the next slide, Matt. So maybe one of the most important things that we talk about tonight is assembling your professional team. So critical in your success, financial advisor, of course, your practice transition specialist broker, that's going to be kind of the spearheading the effort to have a successful transition. An attorney is going to be very important, and of course, your accountant. So let's go to the next slide, Matt. So I'm not going to steal Stuart's thunder. All right, this is something that I present to potential sellers and in local events that we have. But kind of a couple bullet points here as prepare early, prepare often, right? So ideally you don't want to be the sale to be from a trigger event, right? It happens. Life, comes at us. We don't know, about illness or health or, an injury. But ideally, you want to start preparing, years ahead of your transition to maximize the sale. Don't go on cruise control, right? Meet with your accountant, your professional team regularly. Understand, what is the value of your practice? How can it be effective? Invest intelligently. I've heard some sellers, doctors at the bank say, the stock market went down 20% last year. There's no way I can sell, right? So when you start planning that transition, maybe think about your financial advisor and talking to them about what kind of position you're in. Stuart will certainly talk about practice appraisal. There's plenty of good work that Shine does with doing practice valuations as well, right? So okay, next slide, Matt. This is just a little bit, what banks are going to be asking for preparing for the sale. So typically, depending on the size of the transaction, it'll be 2 or 3 years of business tax returns. There'll be a profit and loss, year to date or year end, depending on what part of the year you're in. Collection reports, production by provider reports. Just a profile or summary or prospectus of the practice. Procedure reports, insurance, payments mix, right? What kind of, is it a fee for service office, or is it a split with fee for service and PPO, maybe some Medicaid, and W-2s for associates and staff related to the owner. So I think we're going to do the questions at the end, I believe, Matt, is that right?
That's correct, Chad.
Okay, so thank you. That's all I had on the banking financing end.
Excellent. Perfect. Thanks so much, Chad. Yeah, so in terms of that, I'm going to bring us into sort of the leasing component, right? And there's going to be some overlap as to what Chad just talked about, and as well as Stuart, but I'll do my best not to take anybody's thunder, as Chad had mentioned. So I'm just going to give everybody a bit of a background on Cirrus, who we are, what we do. My name is Matthew. I manage and oversee the consulting team across North America. But really what makes Cirrus so unique is that we are a healthcare and dental specialized tenant representation firm. Right, we were founded by dentists for dentists nearly 30 years ago. To date, we've negotiated over 12,000 dental and medical office lease agreements. And really beyond that, everything for us is also done in-house. So a full team of lease negotiators and attorneys on staff, some of which who actually just celebrated their 20th anniversaries with us, as well as some of those that we took from the major national landlord side. Right, so we always joke that we brought them from the dark side to negotiate for dentists rather than against them. Now, beyond that, we also deliver nearly 100 continuing education courses per year. We lecture at some of the most major dental conventions, such as the Greater New York, the Pacific Dental Conference, the Yankee Dental Conference, the CDA. We also go to the Hinman and beyond, right? We work with dentists nationwide. Now, in addition to that, right, and one of the common questions that we have is when you're negotiating your lease, everybody's thinking about the first thing, which is how much am I paying in rent per month, per year, et cetera? Is it fair? Is it too much? Right. And who are you getting that information from, and how are you going about that? And that's where we come in as well. Right. We track over 95 billion square feet. We've got 4.6 million properties tracked. Right. And really what we're doing here is as we're going through the process with our clients, whether it be reviewing their leases or negotiating for them, right, we're making sure that we're always negotiating the rental rates and the financials on fact. Right. It's one thing to say to the landlord, hey, we think it should be $20 a square foot here for what I see in the market. But it's a whole other thing to go, no, Mr. Landlord, I know that based off properties of similar size, similar quality, it should be $21 per square foot at max, right? And that's a lot of what we do. And, I'm going to pull up some forward-looking statements, some projections, what your market is doing, right? We can get a lot more specific into certain submarkets based off of your property and certain mileage and beyond. Now, I do have to put the disclaimer up here. Obviously, we don't have a crystal ball, the same as you don't, right? But we have the data to back us up and take a look at the most educated projection of those rental rates possible. So if we're looking at markets like Miami and Tampa, for example, here, right, as you can see, the vacancy rates have fluctuated quite a lot over the past 5 years. And it looks as though the vacancy rates are going to continue to rise. As I'm sure some of you know and have witnessed firsthand, is that the work from home mentality, the shift out of the commercial spaces has created a disparity in what we used to see for commercial leasing, right? The rental rates themselves have stayed on a very equal trajectory. They continue to go up. There should be a small plateau coming into 2024 as we look at the recession. What does that look like? How is that going to affect landlords? Well, really what it's doing to landlords, they're trying to secure those tenancies early and often, right? So get in and get those leases negotiated for fair rates before you're in a scenario where you're at the top end of the market, right? Very similar, Fort Lauderdale, as you can see, the trajectory fairly similar. We saw a much bigger rent increase over the past year and a half, 2 years in Fort Lauderdale, but still you see that it's going to slow down on how much it's increasing there, but all good things to know. Now, as we discussed, there were a couple of people from north of the border as well, but as you can see, the real estate trends and the rental rate trends are fairly similar across most major metropolitan areas. Right, Toronto is going through a current plateau on rental rates. There's a lot of redevelopment. There's a lot of land that developers and beyond have invested in and are not meeting the KPIs in order to get the people into that building. So you're seeing that they're trying to secure that cash wherever they can. And if it has to be a break in rental rates, that's what we're seeing right now in Toronto, for example. Now, looking at LA, New York, once again, similar. New York has seen probably the strangest fluctuation in rental rates out of anywhere else in the country. As you can see here, we have some definite peaks and valleys that have gone on. And a lot of that has to do with how are people operating within major metropolitan areas, with an area in the country that is so focused on, commercial spaces. They've needed to take breaks on rental rates in order to get people into their buildings and secure those tenancies, right? Similar in Boston, similar in Houston as well. Now, really, when we're looking at a lease agreement, I put this one up there just for Chad with a nice check. But when we're looking at a lease, I always like to describe the lease agreement as a check, right? When I ask doctors, what's the largest financial investment you're going to make in your life? Right? Most just automatically defer to a house. And when you're not a dentist, that's usually the case. But as a dental tenant, you have the largest investment into the space of any other commercial tenant on the face of the earth. And, if you're signing a check if you look at it over a 10, 20-year period, you're signing a check essentially for $1 million. You should know every term and condition that is associated with that. Unfortunately, what most of my clients and doctors that I speak to, we look at those first couple pages, we look at that highlight of, okay, I've got 10 years, I'm going to pay $8,000 a month in rent, and that's really all I care about as long as I have my space. But what happens is we don't think about the other 50, 60, sometimes 80 pages that are below those first couple that are outlining all of those strings that are attached to that money you're paying to the landlord each and every month, right? And why is that lease so important? As I was discussing, right? The office location for a dentist is the foundation of your practice, right? You're one of the few industries in the entire world that cannot work from home, right? And with that, you need that physical location. If you don't have your location, what do you have, right? As I mentioned earlier, the investment, the cost to build out your space is far beyond anybody else. And that's why landlords love you at the same time. Unfortunately, I hear, I don't have any leverage going into these conversations with the landlord. I'm just a dentist. I'm only taking up, 1,500 square feet. But that doesn't matter, right? Because your investment into the space automatically is increasing property values, right? It's also very difficult and time consuming for you to move, right? Hand in hand with that investment and that cost to build out. If we had to move our office, it would be fairly simple. A couple desks, some computers, some screens, and we're out the door. Not at all the same for yourselves as dental tenants. And where that lease also becomes so important is through the sale of your practice, right? Without the term, without options, it's nearly impossible to do so. And never mind all the terms and conditions. Can your landlord block the sale of your practice? Can they terminate the lease agreement on you? Right? What other strings attached can they put in there through that practice transition? Right. Now, I did see that there was a bulk of you as well on this evening's webinar that are owner occupants of their own space. Some that may be looking at potentially selling the practice, but retaining ownership of that building. That's a whole other subsegment that lease is still just as important. You have to think about it from protecting yourself, your practice, and your assets at that point in time. And I saw that there were a couple others as well that were looking at starting their first practice. And, as such, if you're looking at buying and you're versus leasing the space, there's going to be pros and cons. Obviously, with buying, it's going to be a larger financial investment up front. You're going to have to buy the real estate. You're going to have to build in some cases. You're going to have to build out the space, right? It gives you the ability to become the landlord, which is great. You get to earn rental income, which is fantastic as well. And it gives you more flexibility. Nobody's going to walk into your practice and tell you, no, you can't do that because it's your space, right? However, when you're looking at the leasing side, for those that are in debate, it requires a smaller upfront investment, right? You're only building out the space. I say only, but it's still obviously a large investment, but it's less in comparison to when you're doing both, right? Which also gives you greater working capital towards the build out. And if you do decide that you want to relocate in the future or you want to expand, it's a little bit easier to do so, right? Because you have that flexibility to relocate if need be, or take adjacent space that's already built for you. Now, when we're looking at the lease agreement, I'm not going to go through every single one of these line items with you this evening, right? That's something we can do on our own time, of course. But there's a number of items in here that do affect your ability to sell and your continuity and control over your space, right? When we're looking at components like alterations, when you're making that investment into the space and you're building out the space, do you own everything that you've now installed? Most of the time, the landlord's included language that says that you don't own any of it, right? It now automatically becomes property of the landlord. Now, in other components, what about a demolition clause? If there's a demolition clause in your lease and you're looking at potentially trying to sell the practice, but the landlord can demolish the building at any point in time. Now, Chad, how easy is that to go through you to get the financing required, right? There's a lot of various components there that, one simple clause can make a very large impact on not only your own continuity, but your ability to sell in the future, right? There's the assignment provision, which I'm going to go to in further detail as well today. But, do you want to have the landlord have ability to look at your financial statements? There's a lot of landlords that love to look at financial statements when you're getting ready to sell, so they can get a general idea as to what is being produced within this space. And if I know what the production is, what can I do as a mechanism to increase rents upon that transition? Right now, when you're going through and you're looking at your lease, there's a number of these components and these questions that are important, even if you're not planning on selling right away. But for those of you that are looking at selling in the immediate future, keep in mind and ask yourself these questions. Do you know when your lease expires? Do you know when your option to renew deadline is? If you have options to renew on the back end, how many of them are there? Right? What are your options transferable? Right? Needing term in order to sell the practice, right? In order for Chad to give you that loan to acquire, right? If you don't have transferable options, there's only 2 years left on the lease. You don't necessarily have the amount of time in order to go through with that acquisition, right? Are you going to be personally liable post sale, right? Is that going to continue with you for how long, right? Does the landlord have the ability to demolish and relocate? I would encourage everybody, I'll just stay on this slide, just take a quick picture of this. It's a great exercise for later on, just to go through and see if you know the answers to these questions. And if you don't, I would greatly encourage that you do take a look as to what that looks like for you. Right? And same for anybody that owns their own real estate. I know there was a handful of you. I would take the picture of this as well, right? Or do you own your property in your personal name? Is it held by a corporation? Who owns the practice? Are you paying yourself rent? Is there that track record and history? How are you protecting yourselves? Right? All of that. But I would definitely take a picture of that for yourselves as well. Now, when we're looking at the transition planning, these are sort of the 7 major components to think about as we go through. Number 1 is the assignment and subletting provision, which, as I mentioned, I'm going to go through that in greater detail just on the next slide. But this is essentially the section of the lease that dictates how you can sell the practice, to whom you can sell the practice to, and what the landlord's overall involvement in that process actually looks like. Right? Very important to know. When you're looking at rental rate increases, right? Are you going to have a practice that's vastly above market when you're looking at selling? Right? It would make your practice less attractive for that acquisition. Right? If I'm comparing practice A and practice B, and everything else is equal, but one is paying $80,000 a year in rent, and the other is paying $60,000 a year in rent, I'm typically going to go with the lower rental rate. Right? Now, other things like consideration, also important in the assignment and subletting section. This actually gives the landlord access to proceeds of sale. Right? You sell the practice and the landlord goes, no, I'm going to take some of that for myself. Right? Other components like death and disability. What happens if, God forbid, something is to happen to you? Physical injury, any form of mental incapacitation, or worst case scenario, you are to pass away. What happens to your practice? Is it just going to sit there? Are we able to terminate the lease? Are we able to sell on looser transition provisions through the lease agreement? All of those are important considerations alongside the personal guarantees and that continuing liabilities and the financial terms. Right? So looking at the assignment clause more closely, right? As I said, this is the section of the lease that dictates how you can sell, right? It's the transfer of the lease agreement from one party to another for the remainder of the lease term, right? Ensuring that this is properly structured will ensure a smooth transition between yourself and your incoming buyer. It will alleviate or should alleviate you from a vast majority, if not all, of the liability post-sale, right? And just as an exercise, this is a typical assignment provision in a lease, right? This, I could say 75%, in some cases, I would say even higher. But if we're looking at just this paragraph alone, the first issue here is that if the tenant wishes to assign or sublet, now assign means to transfer, right? And it's essentially, in this case, to sell the practice. You must first have received the consent of the landlord, right? Now that's very common. I'm sure if you guys were landlords, you would want some say as in who can come into the space, who can leave, etc., right? But when we're looking at this where there's no real language discussing reasonability, what if the landlord doesn't respond in a timely period? What happens if the landlord wants to leverage their consent to the sale of the practice, saying, no problem, doctor, I'll let you sell, but as a result, I'm going to increase your rent by 15%. Well, what effect is that going to have on a buyer? What effect is that going to have on you moving forward? Right. The second issue here as well is that the landlord shall have the following three options. One is to approve. 2 is to decline your request, and 3 is to terminate the lease agreement upon the effective date. All right, well, now you've gone to sell, you've found a buyer, you're ready to go, you're asking the landlord for consent, and the moment you do that, the landlord turns around and terminates your lease agreement. Well, what effect is that going to have on your practice? All right, what effect is that going to have on the sales steward? Right, that's a major implication. So when we're going through, we need to make sure that the landlord can't pull the rug out from underneath you and stop you from being able to sell a full turnkey dental practice. Right. In addition to that, it also states the landlord shall have the right to revise the minimum rent to be paid during the remainder of the term. Right. In some cases, landlords will just present that to you as a condition for the sale. But in this case, this landlord actually went as far as to say they're going to increase the rent to the minimum market rent or 15%, whichever is greater. Right? If any landlord on the face of the earth has the ability to receive 15% more rent on one tenant, they're going to utilize it. And once again, what effect is that going to have on your buyer? Are they going to get scared off and lose interest in buying your practice? Are they going to try to devalue your practice because of this? Right? All of these components need to be cleaned up, especially through the assignment. And further, this is that consideration language I was mentioning, but should the tenant receive from the assignee or subtenant any rental income, cash goods, or any form of consideration in connection with the assignment of this lease, the difference between the annual rent and any such rental income, cash goods, or other consideration shall be paid directly to the landlord within 30 days of receipt. So that means that whatever your base rent was going to be on that lease, let's say your base rent is $100,000. You sell the practice for $1 million. Well, landlord has the ability to come after $900,000 of that proceed of sale. Right? Absolutely ludicrous. Landlords like to argue that, well, because it's my location, I should be able to get something out of this. But we all know that if we pick you up and move you down the road, right, we're still going to be successful. We're still going to be profitable. But we cannot have the landlord bite in to any of the proceeds, your hard-earned sweat equity that you've put through the practice. Right? And further to that, the landlord also states here that you're going to remain continually liable. So now, if your future buyer ever goes in default, the landlord has the ability to come after you for rent and any other obligations owed on the lease. Right? Then that, in this case, there's no limitation on that. If the lease keeps renewing, your liability keeps renewing. I had a doctor that sold his practice in 2001, and the lease that I reviewed yesterday that was just signed in 2019, he was still continually liable on that lease. Right? So very important that when you walk away, you don't have to think about the lease agreement ever again. Right? You get that smooth exit. Right? And just as an overall snapshot, that's just in one paragraph alone. Those are the number of red flags. Right? So any of you that are looking at those transition timeframes, very important that you take a look at what your assignment clause says and how to affect that change. And the cost of this mistake could be the inability to sell the practice. It could be having to absorb significant increases in rent, remaining liable as a guarantor for performance, right? Paying the landlord for a portion of your sale. Be $250,000 to $750,000 plus in liabilities that are just lurking in that assignment subletting provision, right? And now, as an offer to everyone on this webinar, right, we have something called a critical dates and risk analysis, essentially a lease consultation. But for any of you that are interested, I'll go through, make sure that you're paying the right rental rates, that not only is the assignment clause up to snuff, but any of the additional other liabilities in there are taken care of. It's typically about $2,000, but as a courtesy to everybody on this evening's webinar, they'll be completely complimentary. But if you are interested, I'll have a poll afterwards. You can reach out to me and beyond. But without further ado, I'm going to pass it over to Stuart.
Thanks, Matt. Do I have that screen working properly?
Yeah, I can see it.
Okay. All right. Thank you very much. I've been in the transition business for 30 years this year, and I can I know you didn't think I was that old, Chad, but we've done a lot of these transitions over the years. And one thing I can tell you is that when we speak to dental associations, study clubs, or whoever we're talking to, all the things that you've heard so far are the things that we talk about constantly. A long time ago, I learned that if you're going to hear something once, maybe you can disregard it. But when you hear it more than once, start paying attention to it. So a lot of the things you have already heard, we're going to allude to once again. And the information is absolutely clear that this is exactly what goes on in the real world transitions. So the options that you're going to have in transition are typically going to be an owner-to-owner sale, that you're going to have, in our minds, a short transition period, 1 to 4 weeks for general practices, could be a little bit more for specialties. It's all variable, but they're short transition periods. What you get is immediate cash at closing. We try not to have seller carryback notes. We want to see the separation of buyer and seller, so a buyer can come in and actually take control of the practice. If you have an associate, then sometimes you're going to have an associate will buy the practice and you may remain as an associate. So you may just flip roles post-sale. It may be a hard time finding the right associate, and we have found that it usually takes an average of 3 different associates to run through an office to find the right one, if it's even going to happen. The associate may buy or want to buy into a partnership, and we feel that usually this is going to take an association period. This is not going to happen quickly, and the reason to do that is so that the associate will be able to build up enough production in the practice to support the partnership overhead. They can't just walk in and start taking over without doing something to actually provide enough money and income for them to be able to afford it. Usually these are internally financed. I don't think Chad on a regular basis does these associate buy-ins, although it's probable that he could. When you as a seller enter into one of these things, you're going to find out that this does not clear you with money from the sale, that you're going to have some continuing liability with that association. So usually they're internally financed. The other way that we're seeing practices transition now are the multi-office groups. We'll see small DSO type groups in an area trying to put together small groups that they can at one point operate and potentially then sell to a larger DSO. And then, of course, the larger DSO buyers are out here. So we're going to talk a little bit about some of these throughout this presentation. In general, we see that the seller's market is consistent throughout the country and certainly most of Florida. Practice values continue at peak levels in most areas, and we're seeing more purchasers and sellers, certainly in the state of Florida, than we've ever seen. They're broken down by estimate. The individuals, somewhere between 63 and 65% of the market, we see going back to single docs. The multi-practice ownership is going to be, and it is somewhere to 12 to 15% of the general market, and the DSOs are somewhere in the 15 to 20% range. So that gives you a pretty good breakdown. And there was some recent studies that we've seen that look to show that these numbers are pretty well consistent over time, and this is what the expectation is over a longer period of time. So the question that everybody's got, thing that I do all the time, things that we work with, is what is a dental practice worth and how do we determine that value? By definition, the price of a practice is going to be determined by buyers and sellers. I, as an evaluator, can put numbers on it. Anybody else can tell you what they think the numbers should be. You can go to the internet, talk to all your friends, but ultimately, a buyer and a seller are going to come to an agreement, and you're going to get a willing seller and a willing buyer, and that's how this is going to happen. That both of them should be informed of the relevant facts, and nobody's under any duress to make a sale. That's the normal definition of market value, defining market value and the sale of the practice. The majority of the practice sales nationally are somewhere between 60 and 85% of the last year's gross. I know Chad has already gone deep into his pockets and said he'll go up to around 100%, but I can tell you that that's going to be a hard squeeze. He says it, but he's not giving it up all the time. It's got to be a really, really good practice to give up 100%. So you're going to see most of the numbers somewhere in the 60 to 85%. This is not a valuation. So what do we see in dental practices that affect the value? The value is a function of net income and risk. Now, net income is calculated historically. You cannot go forward and project what a buyer is ever going to do. So when we value a practice, we are looking at historic numbers, and the buyers are looking at risk. Chad is looking at risk to see whether or not they can justify lending money for this particular practice and for a particular buyer. And these things are pretty specific. They are related to the buyer's financial status and whether or not the buyer, in everybody's opinion, has the ability to actually do this practice that they're looking at. We see buyers looking for different demographics, different areas. One of the first questions that we ever ask a buyer is, where do you want to live? Some people want to be in urban settings, suburban. Some are in small towns, somewhat larger towns. They're going to look for different types of industries to have their patients working in, so that they know that there is some sort of an income in the general area that they can depend on for their patients. If there is new housing starts, or there are recent things that are going on, all these things can affect the value of the area also, and affect the value of the practice, something that somebody's willing to pay to take over a practice. The number of treatment rooms is an important thing for many buyers now. At one time, a 4-operatory office was considered to be a reasonable size office. We are now getting requests as a minimum of around 4, up to 10 or more operatories. So depending on what you've got, if you've got a 2 or 3 operatory office, I can tell you that that does not carry the same value to buyers as the larger facilities do. The age and the condition of your equipment is also important. Buyers in today's market, for the most part, have never seen old equipment. They don't know that this stuff continues to work for years and years. And even though I can say, and you can say as a practitioner, that this stuff has worked for a long time and has really no reason to stop working at any time, we have plenty of buyers that are willing to look at an office, but as soon as they see old equipment, say they've got to replace everything, and that's going to affect what they're willing to pay for your office. Technology has exploded in the last 5 to 10 years. If you don't have digital stuff in the office already, if you don't have computer technology, scanners are getting to a point where the docs coming out of school want to see them in the offices. If you do not have these things, the immediate thought by a buyer is that they're going to have to add it to your office in order to be able to practice there. They're not willing to pay the same amount of money for an office without the technology. Technology costs are in the hundreds of thousands of dollars now, depending on what level of technology you want to put into an office. If you have room for expansion, that's good. It doesn't have to, it's not a deal breaker for everybody, but if you've got a 4-operatory office and they really see themselves in 6 to 8 or 10, then not having room for expansion can be a negative to them. You want to have nice business offices and nice reception areas. And if you don't have these, then they're going to look at these offices saying that there's much more they've got to do and put into these offices in order to get them up to the standards that they as a buyer want to work in. So historically, if we got a practice running at a 50% operating overhead, that was a pretty good number. We're seeing now that number is almost not achievable. We're seeing numbers now that if we get somebody at 60 to 70% operating overhead, that's about what the norm is going to be. So what's happened certainly in the last few years with staff issues is that the staff costs have escalated very quickly. We used to see numbers in the 20 to 30%. Now we're seeing them regularly in a 30, 35% or higher range, depending on where you are. The more long-term employees you have, the better it is for your stability of the practice. However, those long-term employees are part of the cost increases to keep them happy and keep them there. Healthcare benefits have also increased dramatically recently. Retirement benefits. These are the things that staff is looking for in order to stay with you, and you've got to be able to provide something to these folks or they are going to be moving around. Occupancy costs, as Matt was talking about, have gone up. We're now seeing where we used to see around 6% as a national average or a norm. Now they're creeping up and close to 10% or more in some areas. So all these expenses, certainly the staff is your largest item of cost for practice. So when the staff costs go up and the occupancy costs, your rent goes up, these two things, you're pretty well locked into overhead. The rest of the things there are small numbers, they're going up too. So all these numbers together are going to cost you more to operate this office. And these are the things that are driving the valuation numbers. So the other things that we look at is when we do an analysis of the procedures that you're doing, the amount of specialty procedures that you provide may work real well for you. However, if we don't have a buyer who can fit into your practice and do your procedures, then the value of that practice to them is not what you want to hear. It's going to be less because they're going to take a financial hit in their minds when they're buying it. If you have a lot of insurance plans that are low paying, you have HMOs, Medicare, Medicaid, Delta Premier, anything that caps your fees, these things will also cost you money in evaluation. Fee-for-service practices certainly are not as plentiful as they used to be, but a lot of them still exist, and they're very successful when they're there. If you have staff instability, it might be okay not to have the longer tenured staff, and you may think that you're going to get away without benefits for them, but instability is going to cost you a lot of money just by bringing new people in or even trying to find them. If you have a member of your family, part of your family is on staff, you need to look at that carefully before you want to get out of your practice. Because if your spouse is at the front desk, I can promise you that your spouse, when you sell the practice, is not going to stay behind for very long. You need to make that move a lot sooner than at the time of the sale. We've also seen cases where telephone numbers and or websites are actually owned by third parties, and you're actually renting them. So you need to look carefully at who owns these things, because if you don't have a transferable phone number, if you don't have a website that can go with the practice where the practice has been using it consistently, that's not a good thing to show a buyer. If you have an associate, if you don't have a restrictive covenant, that's his trouble. I can tell you that one of the first questions that all the banks want to know about is associates and whether or not they have the enforceable and transferable restrictive covenant. If that associate is allowed to go next door and take patients with them, the value of your practice will not be the same as if you've got that contract in effect. And the lease. If you don't have a lease, you are not going to sell a practice under the same terms and conditions as you will with one. And many dentists, most dentists, do not utilize their advisors or attorneys or somebody knowledgeable in that field when they're entering into the lease. So the time to do it is before you sign a lease to get this thing straightened out. So how do we determine value of a practice? There's something called a market approach, and that actually has two different ways to look at it. There's a guideline transactional method that looks at national statistics. There are some statistics that are published. I can tell you that most of these sales that are done are private sales. I can tell you that the people who really know what's happening there are buyer, the seller, the banker, the attorneys, and a broker. Those are the ones that know exactly what's going on. We don't all contribute to this Goodwill registry or the Pratt stats. We don't always give our stuff to them. So these numbers are not necessarily going to reflect what goes on a local market. So a market approach looking at the local market will look at the makeup of your practice, size and location, the technology, whether you have specialty in there or not. And these markets are segregated by region. So somebody in the southeast of Florida is not going to have the same type of practice as somebody in Central Florida or even in the Panhandle, in the West Coast. These are all different areas, and we need to look at them as regions. They are not singular areas. So when we look at income approach, what we're looking at is, as Chad was talking about, a review of 3 years financials. We look at tax returns, profit and loss statements. We're going to allow for adjustments in here. We allow for adjustments to some dental supply costs, office expenses, rent, if you're the owner. So if you're the owner of the practice and you're not paying yourself market rent, then there's an adjustment to be made there. Professional fees, depending on who you're paying them to. building repairs and maintenance. These categories, with the exception of the rent, are often categories that we know are, well, maybe not quite all practice related. So we're willing to make some changes in there. We're looking really for the true earnings of the practice. We're going to take out the big numbers are going to that we're willing to take out very quickly: continuing education and travel, dues, certain insurances. You need certain insurance to run the office. Other ones are certainly your choice. So we'll take out the ones that are your choice and let the buyers make that decision. Your pension contributions are go back into the practice. And if your family members, you have a child that's getting paid to do whatever they do, these numbers need to be worked again and brought back into the practice. So we're going to look at all these different ways that the money is being spent in the office and be able to put back money in to the practice that actually goes with it to the buyer. But I will tell you that if Chad and I have to look real hard to find out where that money is, the harder it is for us to normalize it. And most of the time, we are not willing to look into your general ledger to figure out where you spent your money. So at some point, you're going to have to own up to what you've done. And we look at the tax returns to really prove that out. So when we do the calculation of value, we look at these three methods. Usually we're going to throw out one of them and we'll look at two of the three and just get an idea of where we stand there. But the final opinion of value that we give is based on our experience and the information that we've been given. So when we do valuations, we're going to tell you which one that we've used. Capitalization of earnings method is the income method. And this is a short presentation, so we're not going to get into capitalization of earnings and see how that's done. But the capitalization of earnings is actually that income method. So when corporations buy practices, how do they do them? They're looking at something called EBITDA. You've probably all heard EBITDA. And here is exactly what it means. It's earnings before interest, taxes, depreciation, and amortization. So what the DSO is looking for, what the buyer is looking for, is what the true profits of the practice are before any of these other things are paid. If you look at a solo practice, a general practice, and if you look at it as an EBITDA number, what you do is you have to add in the dentist, the provider, as an employee of the practice. You'll typically see numbers in the 3 to 4 times EBITDA range. So whatever the earnings are, somewhere in the 3 to 4 times that number will be close to what the valuation comes in with. This will be usually in a 75, maybe up to 125% of gross revenue. But again, you've already seen that we're not really using gross revenue, we're using net numbers. When you have practices that are multi-practice roll-ups, we've seen EBITDA at 4 or maybe up to 12 times EBITDA, depending on the situation. The numbers now for DSOs are somewhere in a 4 to 8 range, and it's hard to get the 8 without a lot of EBITDA, I can tell you that. So you're going to see numbers in a 4, 5, or 6 range in today's terms with these roll-ups. What is being done is they're assessing risk, and the lower the risk, the higher the multiple, the higher the risk, the lower multiple, and ultimately it's the net income times this multiple to get to a value that they're willing to pay. As a buyer and a seller, there are tax implications to the sale. A seller is going to get taxed at capital gains for the intangibles, that's the goodwill. The buyer is going to amortize that over 15 years, that's IRS rules. the tangible assets somewhere to 20 to 30% of the total purchase price, and that's taxed as ordinary income. The buyer gets to depreciate it, amortize it, and expense it. So the buyer is going to depreciate under a normal sale, under a cash sale, is going to amortize these things over 15 years and somewhere in around 5 years on the tangible assets. So DSOs, DSMOs, what are they? They are based on two fundamental principles. One of them is that practice overhead, a lot of practice overhead is inefficient. And secondly, that the revenue of the practices can be increased. They capitalize on the idea that doctors don't want to deal with management. Selling doctors want to get out gradually. And some of the sellers actually believe that nobody can or will buy the practice. That's not really what's happening out here, but they still feel that. What we've seen very recently, again, is that these DSOs are looking for partners, and they are not looking for these docs to go walking out of the practice at any time soon after their acquisition. Again, they're going to go to the EBITDA numbers for numbers. So the appeal to a seller is that you can potentially get money for the practice, so it's over market. You can take some equity off of the table by doing it. You want to theoretically allow operational headaches to transfer to somebody else, and hopefully the DSO can address problematic aspects of the practice, so you don't have to deal with insurance companies anymore, increased staffing costs, and the cost for goods and services. When these things go up, that's not your problem. That's what you think that you're going to get away from. The theory and the fact are somewhat different in a lot of cases. So at sale, you're going to get a majority of the cash at closing. You're going to usually have a seller holdback note. You might get some local practice entity money or equity in the local practice entity. You might get equity in a national entity. It just depends on what they're willing to give you. You will normally, in today's numbers, be required to stay for 3 to 5 years to see the rest of your money from that sale. And during that time, you're compensated as an associate. And we're going to tell you that it's real important to review that post-sale responsibility before you make this decision. So you hire a broker, do it yourself, and let's talk about 2 cases, and I'll show you what goes wrong with these things or can go wrong. Talk about a general practice in an affluent area. It's in a professional complex that has 7 ops, 3 for hygiene. You have an overhead of about 60%, 59%, 20 new patients, 30 new patients a month. Hygiene's 28% of the overall collections. There's an associate in the office. Associate produces about 13% of the office income. The office is owned by the seller and not expected to be sold. The office and the equipment are in excellent condition, above average and really nice practice. Market demand in the area is real high. So it's not going to take a long time to find a buyer if a broker gets a hold of this thing. So the seller approached the associate to purchase at an appraised value. The associate says, yes, I'll do that. The associate then applied to bank financing. The bank was not known for practice acquisition financing, so it was not Chad. We know Chad didn't do this. After 3 months, the bank declined the deal. Another call was made, another practice acquisition lender was contacted, and that one took about 6 weeks to get an approval. The associate and the seller then hired attorneys for the contract negotiation. And I will tell you that once the attorneys are hired, your conversation with your buyer or your seller is now going to come to a screeching halt, and everything is going to start going through attorneys. So what happened now is that the seller decided that the seller wanted to continue to stay with the practice for at least 3 years. And the original valuation assumption was not that. The original assumption was that the seller was not going to continue to practice, in fact, needed to get out. So when that happened, the seller staying reduced the purchaser's net income because you had to pay two producers for the same income. The seller retention compromised the transfer of the patients and transfer of the goodwill. As long as the patients saw the seller was going to be the one that they're going to choose to do dentistry for. And that we see that all the time. The seller was the owner of the condo, but had no intention of selling it to the buyer. And I've written here no immediate, but there's really no intention of selling it at any time in the near future. So during negotiation, the attorneys got together and they started fighting with each other. One of them wasn't familiar with normal terms of acquisition. The purchase price, agreed to purchase price, now got reduced. And a few months later, the associate said, "I've had enough." The entire process took over 7 months, and the only ones who got anything out of it were the attorneys who spent time going back and forth, making this deal not happen. Here's another one where you talk about somebody talking about needing a partner, and how can this go wrong? So in this case, we have another affluent area, professional condo complex. Space is owned by the owner, and upfront is not for sale. This never was discussed. The office had 7 ops, 2 were hygiene, collections were stable. The associate produced 14% of the office income, and the collections increased with the associate there. So the associate was working and it worked out okay. Practice overhead was 69%. I have a line in here that tells you that the office production for hygiene was about 17%. In the previous scenario, the hygiene was producing about 28%, 23%, 25%. Somewhere in that range is what we'd really like to see. This one's at 17%. And the way I know this is that when the valuation was done, when looked at all the numbers that came in for the practice, I looked to find out what the procedures were the hygienists were doing or not doing, and found out that the hygienists were not billing out for some procedures that they should have been. And this was costing about 10% of the total revenue of the practice over many years. So the valuation process actually brought out the fact that there was a problem that the owner of the practice could take and do something with. The new patients coming into the practice were not associate driven. They were all done by the practice, by relationships that the practice had had for many years, and referrals from the patients. There was no change in the dental equipment. Everything's in good shape. Again, a very high market, a very, very high demand for this market if it was going to be sold. So what happened here? The associate goes to the owner and says, "I want to be a 50% partner." The owner pre-partnership was taking home about $775,000. The associate was taking home about $235,000. As 50% partners, the analysis showed that the owner would be making about $585,000. The associate I can't. The associate's what, $450,000 because my screen's blacked out on that side. The debt service is 105. So the associate under the same terms would be making $345,000, which is good for the associate. The owner was not interested in retiring anytime soon. The owner recognized the disparity with the disparity of production. He was going to lose about $200,000 a year, and that loss of ownership and control goes along with that. And he said to me, "What can we do with the associate? I really don't want to lose him." I said, "Well, let's increase the compensation to the associate so that he's going to make more money." And a few months later, the associate says, "No, that's not good enough for me," and left. So there's two cases where similar kinds of practices, very profitable practices, really good practices, could not make the things happen. And of course, in the second one, we're talking about partnerships. The seller decided absolutely not. I didn't want this associate in here, and he wasn't the one pushing for the associate anyway. So what we'll tell you in general is if you're considering a transition in 12 to 18 months, that you should get a consultation with a transition specialist, somebody who knows what they're doing with this and can evaluate your practice. Look to establish a value, get for the practice, get a practice valuation. Keep practice operating, just like Chad told you, don't back down on this thing. Now, this is also a time that, as I told you in one of these other cases, we were able to find things in the practice that could be fixed, could help the practice, and practice valuation, the way we do them, sometimes allows us to give you some information that you can take home and use in the interim between when you do that valuation and when you actually sell it. If you're going to be further out, you can talk to your Henry Schein dental rep. They have a program that they can run for you and will actually give you a lot of the metrics that I've been talking about, and let you find out what some of the things in the office are that you can do to help yourself out. Again, talk to us as transition specialists. If you do it in advance of when you're actually going to do this transition, we can often help you make it a lot easier. At some point, you need to get a current practice valuation, and the time to do it would be in advance of when you actually are going to use it as a tool to get out. So if you, for attending this webinar tonight, are interested in doing practice valuation, we will give you a 10% off for the full price for the practice valuation. And you just need to mention to us that you were on the webinar. We'll have a list of it, and we'll be glad to apply that discount for you. And I thank you for your time.
Excellent. Thanks so much, Stuart. That was it was fantastic. We're just going to pull up a final poll here to end things off. And just going to be, for those that are interested in the evaluation with Stuart, speak with Chad or myself. Just going to launch that up there now. So if you don't mind taking a quick moment, just fill that out for us. That'd be fantastic. And then I will open up the floor to any questions that anybody may have here this evening. Additionally, I did have one that was asking for the assignment clause to be shared with all the red highlights. So I'm just gonna steal the sharing away from you there, Stuart. Just bear with me 1 second. Yeah, we have that right here. Let me know if everybody can see it. Let me just see here. Yeah, that should be up there now, but if not, I'll share like this. There we go. Perfect. So if you can see that screen, just let me know, that'd be great. But yes, this is the highlighted assignment provision with all the red flags there. Just as Stuart had mentioned, if you are interested in having a consultation, I know there are a couple of references to the lease agreement term, etc., lease rates. If you are interested in having that consultation, more than happy to do so. And we're more than happy to go through. And with that, once again, I'll open up the floor to any questions here. Stuart, this one's for you. It's a question from Dr. Patel. Is how do you evaluate a practice where the owner is not working and is run by associates only?
So that practice income is actually going to be much closer to EBITDA than an owner operator, because all the dentistry that's being provided is being done by associates. So from a perspective of having to add an owner back in as a provider, that's already taken care of, and we don't need to do that. How do you do that? It's really EBITDA. That type is an EBITDA type of calculation, and go to the tax returns. We'll go through and ask you the same questions about whether or not there are discretionary monies being spent, where they are, and we can try to add some of that back. But actually, those are some of the easier ones from the perspective of add backs, because we don't need to put a producer in there for you.
Excellent. Right. Any other questions here? Doesn't look like it. So excellent. Well, for anybody that does have any questions for any of us, our contact details are on the screen here. Myself, Stuart, as well as Chad. Feel free to reach out to us directly. We're always more than happy to help. But I thank everybody for their attendance tonight. Chad, Stuart, thank you very much for joining us. It was a pleasure.
Thank you.
And we look forward to speaking with all of you in the future. Thank you all. Have a great evening.